Hi everyone, welcome to Vault's official YouTube channel. So on today's video, we are going to understand three critical points. One, what are stablecoins? Number two, we are going to understand the Terra Luna crisis. And number three, how does this Terra Luna stablecoin crisis is going to impact the crypto market at large? So let us get that discussion started. I will try to explain things in a very easy to understand language. And let us start our conversation by understanding what stablecoins exactly are. So there are three key parts that you need to understand about stablecoins. So first and foremost, that stablecoins are a type of a crypto. Crypto is an asset class. There are 1,000 different types of cryptos. For example, Bitcoin, Ethereum is a blockchain network. You have NFTs, you have layer 2 scaling solutions. There are a bunch of options available within the crypto ecosystem. And stablecoins become one of the type of cryptocurrency, so to say. Now comes the question that, hey, what type of cryptocurrency is it and what utility does it provide? So very quick discussion there. Basically, you can imagine the world to be in the following order. For example, there are fiat currencies, USD, INR, and there are cryptocurrencies like Bitcoin, Ethereum, etc., which are pure cryptocurrencies. Then there is a bridge which is called as a stable coin, which connects fiat currencies with traditional forms of cryptocurrencies. Now I'm just helping you visualize the entire spectrum, and now let me get into the details of it. Now there are various type of stable coins. For example, there is something called as USDT, there is something called as USDC, there is something called as UST. These are all stable coins. Now you'd say that, okay, what is the need of these stable coins? So let us have a very quick discussion there. Basically, if you consider any form of traditional cryptocurrency, for example, let's pick Bitcoin. Now Bitcoin is an extremely volatile cryptocurrency. It was extremely volatile when it started. Now, over time, the volatility has come down, but it is still very, very volatile. Now, what type of problem does it lead to? It leads to a host of problems. For example, if you're trying to buy a Tesla, and by the time you reach the showroom to buy that Tesla, the price of Bitcoin might change. And imagine yourself carrying one Bitcoin. You can't literally physically carry it, but let's just imagine that you're carrying that one Bitcoin. By the time you reach the showroom to take possession of that Tesla, the price might change and it becomes a problem for you. So traditional cryptocurrencies have a problem called as the volatility problem, that the prices change quite aggressively. They can go up aggressively also and they can come down aggressively also. So a solution was built and people thought that, you know what if we can change our Bitcoin into a stable coin? For example, we can convert this into a stable coin such as USDT, USDC or UST. Okay, then you might ask that, okay, this is still a cryptocurrency. So what is the benefit? Okay, the benefit is that these currencies are pegged to a more stable underlying asset, for example, a US dollar. So typically the way stable coins function is that one USDC or one USDT or one UST should be equivalent to one US dollar. So that is how the equation should hold true. So the primary function of stablecoin is fairly simple, that they allow you to hedge this volatility, that you could convert your volatile cryptocurrency like Bitcoin, Ethereum and bunch of other cryptocurrencies which are extremely volatile into a crypto asset which is called as a stablecoin, and that stablecoin is pegged to a more stable currency, something like a fiat currency. So that is what the primary benefit of stablecoin is. There are additional benefits. For example, you can go and stake your USDT or USDC. Staking simply means that you are simply opening up an account on a DeFi protocol, the way you open up a bank account and you start your savings account. When you are putting money in that savings account, what does the bank do? It gives you a certain rate of interest on that savings account. Similarly, when you open up a DeFi account and put your stable coins into that DeFi account, so what does the DeFi protocol does? It also pays you a certain rate of interest. So that is called as getting a certain yield on your stable coins. So there are a bunch of other utilities and functionalities of stable coins, but these two would be the primary ones, that it helps you hedge volatility, and second, it helps you earn a return very similar to how you would be earning a return if you were to open a traditional bank account. Now there are two types of stable coins that exist. So the first category is called as the non-algorithmic stable coins. The examples here would be USDC or USDT. So what happens here typically is that one USDC, for example, needs to be equal to one US dollar. And why would this equation hold true? Because every time a USDC is released onto a blockchain network, or every time one USDC is produced in the world, there is someone who should be buying one USD and keeping it into a bank account. This is very similar to the monetary system that existed in the 60s and early 70s, that US dollar was pegged to gold. So every time the government printed $1, it had to keep a certain amount of gold into its locker. So this mechanism is called as the pegging mechanism. And for this equation to hold true, what needs to happen on a non-algorithmic coin? That someone needs to buy this USD and take possession of it and keep it in their locker. And only then they are able to release this USDC onto a blockchain network. Now it comes out in the audit process whether this mechanism is being followed versus not followed, what are the pitfalls around it. So we are not getting into that part of the discussion, but to give you a conceptual understanding of what non-algorithmic stablecoins are, here this pegging mechanism is manually maintained. Now comes the second category of stablecoins, which are called as algorithmic stablecoins. Now algorithmic stablecoins are simply smart contract based stablecoins. What are smart contracts? Smart contracts typically are computer codes in a way. Here we don't have a person or an organization that is manually buying USD and keeping it in their locker, and only then they are releasing that particular stable coin onto a blockchain network. Here this process is maintained by a smart contract. So how does that process play out? Let us try to understand this by using the example of the Terra Luna ecosystem. Let me give you a very quick explainer of what Terra Luna ecosystem is. So Terra Luna ecosystem comprises of three parts. One is called as the Terra, which is a blockchain. Blockchain simply means that it is a network, very similar to internet, how internet is a network, how Bitcoin is a network, how Ethereum is a network. The Terra part of the Terra Luna ecosystem is the blockchain network. On this, other functionalities are built. For example, on the internet, a lot of functionalities are built. You can write a blog, you can write a social media company, you can write an app like Uber. Similarly, the Terra part of the Terra Luna ecosystem allows to create different set of functionalities by using this blockchain network. The second part is the Luna part, which is the native token. Now, what are native tokens? Native token simply means a currency that allows the powering up of this particular blockchain. Now, third part is the Terra UST, and it is also called as UST, and this is an algorithmic stable coins. Now, the important part that you need to understand is that how these three different components interact with each other in the Terra Luna ecosystem. Now, this is fairly complex, so I'll try to simplify it. Now, here what needs to happen is this, that this equation needs to hold true. That 1 Luna should be equal to 1 UST is equal to 1 US dollar, because UST is an algorithmic stable coin and it is pegged to US dollar, and therefore it needs to be in a pegging ratio of 1 to 1. And if the network behaves in such a way that, for example, 1 UST becomes 0.99 UST equal to $1, then what needs to happen? That UST needs to go up in price. Now, how will it go up in price? It will go up in price when its supply gets shrunk. So people get an option to swap their UST to USD, they will do it. And every time such a swapping mechanism happens, what ends up happening at the back end is that UST is converted into Luna and that Luna is burned so that the supply of UST comes down. So that is the entire mechanism. You don't need to understand the entire algorithmic part of it. But what you need to note down is this mechanism had so far been working really well. Why was that the case? Because the smart contract was working very well. Every time there was a rise in UST, it could be converted into Luna, and that Luna could be burned, and that supply and that pegging ratio of 1 to 1 remained constant. So then naturally the question comes that, okay, if this mechanism was working so well, then why did it fail so terribly? So for that, we need to understand something called as the anchor protocol. Without complicating it, consider Anchor protocol to be a savings account. Now, the way when you go to your savings account, if you deposit $100, you get, let's say, a 2% rate of interest. So therefore, you have an incentive to deposit this $100, and this in the crypto world is called as yield farming. Now, as per the Anchor protocol, what was happening was that if you deposited 100 USD into the Anchor protocol, then you were getting roughly 20% yield up until now. But in March of this year, Anchor protocol, it passed a resolution saying that they will be decreasing this yield. So as a result, there was a bank run, so to say, and a lot of people did not want to buy USD even at a falling prices. Now, this entire problem exacerbated for a series of reasons. First and foremost, there was a general decline in the cryptocurrency market. So there was a lot of negative sentiments to begin with. Then it got compounded because there were multiple arbitrage opportunities and big whales jump into this equation to exploit this ecosystem. These are all conspiracy theory and you can read more about it on Twitter. But to cut the long story short, this entire pegging mechanism between Luna, UST and USD, it got depegged, and UST as a stable coin witnessed a massive fall. So this brings us to the last section of today's video, which is around that, hey, what is the future of cryptocurrencies and what is the future of stable coins? So let me try to explain this situation by using an analogy. So consider, for example, that one of the top 5 tech stocks has fallen by roughly 80%. Does it mean that all the tech stocks are bad? The answer is no. It doesn't work that way. There was fundamental issue with Terra Luna. The fundamental issue was that so far the algorithmic stable coins have not worked well. There have been 2 previous experiments that have been done in this space and they have not succeeded. But on the flip side, if you consider other stable coins, for example, USDC or USDT, and you can check Vauld also, you could consider doing fixed deposit on Vault and it still pays out healthy returns. So there has been no negative impact on USDT and USDC per se. So that is one. So not all stable coins have become bad just because UST has become bad. And second key point is regarding the broad sentiments in the crypto market. So here the point that you need to keep in mind is that the short-term negative sentiments in the crypto world is definitely negative due to this Terra Luna crisis. No doubt about that, because the underlying can be USD and it can also be Bitcoin and other assets. So as a result, some other cryptocurrencies also suffered a little bit, but it's not as if that these cryptocurrencies have gotten stabilized due to the Terra Luna crisis. So in essence, the final message is that not all stable coins are bad. Not all cryptocurrencies are bad. It also means conversely that not all stable coins are good and not all cryptocurrencies are good. So the important point that we must remember as investors are that we must do our due diligence before investing in any particular project. We must understand the risk reward equation. We must consider the utility and we must at least read the white paper and keep a track of key developments that are happening. If you do that, you will stay on top of things and you will be able to weather the storms that is currently existing in the crypto market. I hope you enjoyed this video and I will see you the next time.